I just spent the last 72 hours rereading this 300-page masterpiece by Peter Lynch. I have 47 pages of handwritten notes sitting next to me right now, and I'm going to distill everything down into just the operating principles that actually matter for us building companies, if you're an executive, investing. So pay close attention. The book is called One Up on Wall Street. And here's what's remarkable about it. Peter Lynch ran the Fidelity Magellan Fund from 1977 to 1990. And during that time, he beat the market by such an absurd margin that if you'd invest 10,000 with him at the start, you'd had over 280,000 by the end. Not because he had some secret algorithm or insider information, but because he had a system. And that system is what we're going to decode today. There's a sentence early in this book, page 31, where Lynch says, I'd bet the owners of Polaroid shares were repeating this very phrase just after the stock had fallen a third of the way along its long drop from a high of $143.50. He's talking about what people are saying. If it's gone down this much already, it can't go much lower. And then Polaroid proceeded to fall from $143 to $14 in less than a year. That quote tells you everything about Lynch philosophy. He doesn't traffic in hope. He doesn't care about market timing. He has zero patience for the sophisticated sounding BS that Wall Street sells. What he cares about is one thing and one thing only. Does this company make money? And will it make money in the future? That's it. That's the entire algorithm. So here's the edge that you already have. Now, let me tell you the most important idea in this entire book, and it's going to sound stupid at first. Lynch says, dumb money isn't so dumb when it listens to the smart money. But the smart money isn't always so smart. What he means is this. You listening to this right now, you have a better chance of finding a 10-bagger than the so-called professional on Wall Street. And the reason why is because of what Lynch calls the amateur's edge. Here's how he discovered it. Legs Pantyhose, one of his early multi-baggers, his wife Caroline, came from home from the grocery store one day and told him about this new product she found next to the checkout counter. It was a pantyhose in a plastic egg, and she said, "This is amazing. The quality is better, the fit is better, and I can buy it while I'm getting groceries instead of making a special trip to the department store." Lynch didn't ignore her. He didn't say, "That's nice, honey, but I'm a professional money manager. I have a serious work to do." Instead, he did what every great entrepreneur does. He followed up on that lead. He researched the company, Hanes. He found out that they were test marketing legs in only a few cities, including Boston. He visited the stores. He interviewed hundreds of women. The data was overwhelming. Women love this product, so he bought the stock. And here's the kicker. Legs went on to become one of the two most successful consumer products of the 1970s. The stock went up sixfold before Hanes got acquired, and Lynch found it because his wife went grocery shopping. This is what I mean when I say you have an edge. Every single day, you interact with dozens of publicly traded companies. You eat their food. You use their software. You shop at their stores. You see their billboards. You go on social media. You find what's trending. You find what consumers are talking about. And if you're paying attention, I mean, really paying attention, you're getting market intelligence. That's the analyst on Wall Street won't discover for another 6 to 12 months. Lynch tells this story about a guy named Harry Houndstooth. Harry is obsessed with being a sophisticated investor. He reads the Wall Street Journal every morning. He subscribes to expensive newsletters. He spends hours analyzing charts and economic indicators. And one day, he reads about Winchester disk drives. He has no idea what a disk drive is, but Merrill Lynch just put it on their aggressive buy list. So it must be good, right? He invests $3,000. Meanwhile, his wife, Henrietta, comes home from the mall and says, "Honey, you should see this new store called The Limited. It was packed. The prices are amazing, and I bought Jennifer's entire fall wardrobe for $275. What does Harry say? He says, "While you've been on squandering money, I've been figuring out how to make it. Winchester disk drives is the answer." Winchester proceeds to go from $10 to $5. Harry sells out, delighted he only lost $1,500. Meanwhile, The Limited, the store his wife discovered by literally shopping there, goes from less than 50 cents a share to $52. That's 100 times bigger. If Harry had matched the $275 his wife spent on clothes with $275 invested in the stock, he'd made over $1 million. This happens all the time. People ignore the evidence right in front of their faces because they think investing has to be complicated. They think they need to understand semiconductor physics or macroeconomic theory. But Lynch is telling you, the best stock tips you'll ever get will come from your own life. That's so important that I need to repeat that again so that it is ingrained in you. The best stock tips you'll ever get will come from your own life. Now, here's where Lynch gets systematic. It's called the classification system. He doesn't just say buy good companies. He says there are 6 categories of stocks and each one requires a completely different strategy. Number 1, slow growers. These are big, mature companies growing at about the same rate as the GNP, 2 to 3% per year. Electric utilities, for example. If you own a slow grower, you're owning it for the dividend. That's it. Lynch says he rarely owns these, and when he does, he's looking for a 30 to 50% gain, then he's out. Number 2, stalwarts. These are the Coca-Colas, the Bristol-Myers, the Procter & Gamble's of the world. Multi-billion-dollar companies growing at 10 to 12% a year. You're not going to get a 10-bagger here, but you can consistently make 30 to 50% gains if you buy them at the right price and rotate in and out. Lynch says this is the best bread and butter of portfolio management. Number 3, fast growers. This is where the 10-baggers live. These are small, aggressive companies growing at a 20 to 25% a year. Taco Bell, Walmart, The Limited, Pep Boys. These companies are taking a proven concept and duplicating it. One store becomes 10 stores. 10 stores become 100 stores. And as long as they still have room to expand, the stock can go up 10 to 20 and even 100 times. But here's the catch. Eventually, every fast grower becomes a stalwart or a slow grower. The key is figuring out where they are in the life cycle. If Taco Bell has 50 stores and they're opening in new markets, you're golden. If they've already saturated every major city, it's over. Number 4, cyclicals. These are the auto companies, steel companies, airlines. Their earnings go up and down with the economic cycle. Lynch says cyclicals are the most misunderstood stocks on Wall Street because people confuse them with the stalwarts. They see Ford is a blue chip and think it's safe like Bristol Myers, but Ford can lose 80% of its value in a recession. You have to know when you're buying a cyclical, and you have to have the stomach to get out before the cycle returns. Number 5, turnarounds. These are companies that were left for dead and are coming back. Chrysler in 1982 is the classic example. The stock was at $2. Everyone thought the company was going bankrupt. And then Lee turned it around. Lynch made a killing because he understood that Chrysler had 3 things going for it: a viable product, a manageable debt structure, and a CEO who was obsessed with survival. Number 6, asset plays. These are companies with sitting on something valuable that Wall Street hasn't noticed: real estate, oil reserves, patents. Lynch gives this example. In the mid 1970s, you could buy Pebble Beach, the famous golf course, plus thousands of acres of California real estate for $25 million. The entire company, less than 3 years later, it sold for $72 million. And the gravel pit alone, just one of the company assets, sold for $30 million. People who bought the stock got everything else for free. Now here's why this classification system matters. If you don't know what category your stock is in, you have no idea what to expect. You can't hold a fast grower the same way you hold a stalwart. You can't expect a cyclical to behave like a slow grower. Lynch says most people portfolios are a mess because they own 6 stocks, but they have no idea what they own or why they own it. They just bought things their broker recommended or their uncle told them about. And when the stock goes up, they think it validates their genius. And when it goes down, they panic sell. But if you know what you own, you can't be shaken out. If you bought Chrysler at $2 because you understood it was turnaround play with a solid debt structure, you don't panic when it drops to $1.50. You buy more because you know the story hasn't changed. Now, the perfect company. Lynch has this wonderful chapter where he describes the characteristics of the perfect stock. And this is pure gold for anyone that is an investor building a company, because what he's really describing is the kind of business that investors will pay premium for. Number 1, it sounds dull, or even better, ridiculous. Lynch says the best name for a stock isn't something like Pep Boys, Manny, Mo, and Jack. Who wants to tell their friends at a cocktail party they invested in the Three Stooges? But that embarrassment is your edge. While everyone else is chasing sexy sounding companies like Gensplice International, you're quietly making money on boring profitable businesses. Number 2, it does something dull. Crown, Cork, and Seal makes bottle caps. Seven Oaks International processes the coupons you clip from the newspapers. Safety Clean provides machines that wash greasy auto parts at a gas stations. These businesses will never be featured in Forbes or Wired, and that's exactly why they're great investments. There's no competition because nobody wants to build a boring business. This reminds me exactly of what Sam Walton did with Walmart. He picked up small towns that everyone else ignored. He focused on operational efficiency instead of glamorous marketing. While the rest of the retail was fighting over Manhattan and Los Angeles, he quietly built the most dominant retailer in the world. Now, number 3, It does something disagreeable. Lynch loves companies that make people uncomfortable. Waste Management Pickups a garbage. Service Corporation International runs funeral homes. Safety Clean deals with dirty oil and grease. Most people don't even want to think about these businesses, let alone investment in them. But that comfort creates, hold on, let me say that again. But that discomfort creates a moat. If you can handle the ick factor, you get to own a profitable business with no competition. Number 4, it's a spin-off. When a big company spins off a division into its own publicly traded entity, Wall Street often ignores it. Institutions get sent shares as a dividend and they just dump them because they're too small to matter. But Lynch says spin-offs are often fantastic investment because A, the parent company set them up to succeed. They don't want the embarrassment of a failed spin-off. And B, the new management is finally free to make aggressive decisions without bureaucratic interference. So, Toys R Us was spun out of interstate department stores. The stock went up 57 times. Safety Clean was spun out of Chicago Rawhide. That was a 15-bagger. So, consider spin-offs. Number 5, institutions don't own it and analysts don't follow it. If you find a company with zero institutional ownership and no Wall Street coverage, you find a potential gold mine. Lynch tells this story about visiting Meridian Bank. He asks, "When's the last time an analyst came to visit?" They say, "About 22 years ago." Lynch is ecstatic because that means the stock is mispriced. If nobody's paying attention, the market hasn't figured out what it's worth yet. Number 6, people have to keep buying the product. Lynch would rather invest in a company that makes razors or drugs than a company that makes toys. Why? Because you have to keep buying razors. You have to keep taking your medication. Buy a toy, you buy it once, you're done. And the next year, there's a new hot toy, and yours is worthless. This is the difference between Gillette and Colco. Gillette sells razor blades every single week. Colco had the Cabbage Patch doll, which was a huge hit, but it was one-time purchase. The stock went from $65 to $1.75 when the fad ended. Number 7, it's the user of technology, not maker of technology. Lynch would rather invest in the supermarket that installs scanners than the company that makes the scanners. Why? Because the supermarket benefits when the scanner prices go down, but the scanner company gets crushed by the competition and shrinking margins. This is brilliant. Everyone wants to invest in the cutting edge, but Lynch is saying no. Invest in companies that benefit from the cutting edge. When computers get cheaper, automatic data processing, the payroll processing company gets more profitable. Their costs go down. Their revenue stays the same. Number 8, insiders are buying. If the CEO is buying shares with his own money, that's a signal. If multiple vice presidents are buying, that's even a stronger signal. Lynch says insider selling doesn't mean much. People sell for all kinds of reasons, but insider buying means one thing and one thing only. They think the stock is going up. Number 9, the company is buying back shares. This is huge. When a company buys back its own stock, it's reducing the number of shares outstanding. So even if the total earnings stay flat, earnings per share go up. And earnings per share is what drives the stock prices up. Ford was buying back massive amounts of stock. Teledyne was buying back stock. Crown Cork and Seal bought back stock every single year for 20 years straight. Lynch says this is one of the best use cases of corporate cash. Way better than paying dividends or making acquisitions. Now, let me tell you how Lynch actually researches a company, because this is where the magic happens. Most people think research means reading Wall Street Journal and watching CNBC. Lynch says that's useless. Here's his process. Step 1. Notice something. This can come from anywhere. Your wife discovers a new store, your daughter loves a new toy, you eat a sandwich at a restaurant and it's incredible. You notice construction crews using a specific piece of equipment. Step 2. Do the 2-minute drill. Lynch says before you buy a single share, you should be able to explain why you're buying the stock in 2 minutes or less. And it can't be vague BS like, I think the market is going up, or my broker said it's a company. You need to know, what category is the stock? What's the story? What has to happen for the company to succeed? What are the risks? So let me give you an example. La Quinta is a fast grower. They've built a motel chain with Holiday Inn quality at 30% lower prices. They did it by eliminating the restaurant, the conference rooms, and wedding facilities. They put Denny's next door instead. Now they're expanding from Texas into other states. They have low debt and strong unit economics. The risk is that they expand too fast or the competitors copy the model. That's the 2-minute drill. If you can't articulate that, you don't understand the investment. Now let's go to step 3, call the company. This is where Lynch separates himself from 99% of investors. He actually picks up the phone and calls investors relations. He asks questions. He wants to know, what are the positives this year? What are the negatives? How much of your sale come from your biggest customer? What's your debt situation? What are Wall Street analysts saying about your earnings? Most people never do this. They think it's too hard or too intimidating, but Lynch says companies love talking to shareholders. Just call them. Ask intelligent questions. You'll learn more in 20 minutes than you will reading a year's worth of analyst reports. Step 4, visit headquarters. If you can, go see the company's offices. Lynch says he gets a feel for the companies just by walking through the building. Is it a fancy corporate palace with marble floors and antique furniture? That's a bad sign. Or is it a grime little bunker behind a bowling alley like Taco Bell's headquarters? That's a good sign. It means they're not wasting money on BS. Step 5, check the financials. Now, and only now, do you pull up the annual report and look at the numbers. Lynch focuses on a few metrics. Cash versus debt. Does the company have more cash than debt? If yes, that's great. It means they're not going to bankrupt, even if business gets tough. Earnings growth. Are earnings going up consistently? Are they all over the place? Debt structure. If the bank debt or funded debt, okay, let me say that again. Is it bank debt or funded debt? Because bank debt is dangerous because the bank can call it any time. Funded debt, corporate bonds, gives the company breathing room. Price to earnings ratio relative to growth rate. This is Lynch's secret weapon. He says if you're paying 15 times earnings for a company growing at 15% a year, that's fair. If you're paying 15 times earnings for a company growing at 25% a year, that's a bargain. But if you're paying 40 times earning for a company that's growing at 10% a year run, this is exactly what he saw with Polaroid and Avon in the early 1970s. Both companies had PE ratios of 40 to 50, but they were only growing at 10 to 15%. The math didn't work, and sure enough, both stocks fell 80 to 90% when reality caught up. Step 6, keep checking. Lynch says buying a stock isn't a one-time investment or one-time event. You have to keep monitoring the story. Every quarter, you ask yourself, is this company still doing what I thought it would? If yes, hold or buy more. If no, sell. He gives this example. He bought Texas Air because Continental Airlines was turning around. The stock tripled. Then Texas Air bought Eastern Airlines, that People Express. Everyone thought this was brilliant, but Lynch started seeing warning signs. Delayed flight, lost baggages, angry employees. He should have sold immediately, but he got complacent. He held on, and the stock collapsed. The lesson? Well, when the facts change your mind. Now let's cover the psychology of winning. And here's where Lynch gets deep. He says the biggest difference between winning investors and losing investors has nothing to do with intelligence or access to information. It is psychology. First, most people buy high and sell low. They wait until a stock has already gone up and until it's proven before they buy. Then they panic when it goes down and sell at the bottom. Lynch says you have to do the opposite. You have to be willing to buy when things look scary and sell when everyone else is euphoric. He has this great line. If you can't convince yourself, when I'm down 25%, I'm a buyer, and banish forever the fatal thought, when I'm down 20%, 25%, I'm a seller, you'll never make a decent profit in stocks. This is so hard. Every instinct you have tells you to sell when you're losing money. But Lynch is saying, no, the company's fundamentals haven't changed. A price drop is a gift. It's a chance to buy more at a discount. Second, people confuse short-term price movements with long-term value. The stock goes up 20% in 2 months and they think they're geniuses. The stock goes down 20% and they think they've made a terrible mistake. But Lynch says a stock going up or down after you buy it only tells you that there was somebody willing to pay more or less for identical merchandise. That's it. The stock price is just noise. What matters is the company making more money this year than last year? If yes, the stock will eventually go up. If no, it won't. Third, the sunk cost fallacy. Now this destroys people, okay? Lynch sees this all the time. Someone buys a stock at $50, it falls to $25, and they say, when it gets back to $50, I'll sell. But Lynch says, that's insane. The stock doesn't know you own it. It doesn't care if you bought it at $50. The only question that matters is, would you buy it today at $25? If yes, hold. If no, sell. He tells a story about something asking him about selling a stock. And Lynch says, unless you're confident enough in the company to buy more shares, you ought to be selling immediately. Fourth, people water the weeds and pull the flowers. They sell their winners too early and hold on onto their losers too long. Why? Because it feels good to lock in again, and it feels bad to admit you made a mistake. But Lynch says this is exactly backwards. Your winners are the stock that are proving you right. You should be adding to them, not selling them. And your losers, if the fundamentals haven't improved, should be sold even at a loss. He made a 15 times on Chrysler. He made 6 times on Stop and Shop, a company he thought was just a boring dividend play. Why? Because he kept adding to his own winners when the story got better. Now, there's the 12 silliest things people say. And Lynch has this incredible chapter where he lists the 12 most dangerous myths about investing. Let me give you the highlights. Okay, myth 1. If it's gone down this much already, it can't go much lower. Lynch says he learned this lesson with Kaiser Industries. He bought it at $11, thinking it couldn't go lower. It went to $4. He kept telling his mother to buy at $10, then 8, then 7. She wisely ignored him. The lesson? There's no floor. A stock can always go lower. You can always tell when the stock hits bottom, and that's the myth number 2. No, you can't. Okay, let's be real. You know you can't. Lynch says trying to catch a falling stock is like trying to catch a falling knife. You get hurt. Wait for the knife to stick in the ground and stop vibrating before you grab it. Myth number 3. If it's gone this high already, how can it possibly go higher? This is what people said about Philip Morris at $2 in 1961. They said it at $7, then at $15, then at $30, and all the way up to $124. If you sold because you thought it couldn't go higher, you miss a 60 bagger. Myth number 4, it's only $3 a share. What can I lose? Lynch says cheap stocks are not safe stocks, as $50 stock and a $3 stock can both go to zero. And when they do, you've lost 100% either way. Prices per share is meaningless. What matters is the company's fundamentals. Myth number 5, eventually they always come back. No, they don't. Penn Central didn't come back. RCA didn't come back. Thousands of companies disappear every year. This idea that you can just buy anything and wait is insane. It's always darkest before dawn, and that is myth number 6. Lynch says something is darkest before pitch black. The oil rig count went from 4,520 to 2,200. Everyone thought that was the bottom. Then it went to 686. The railroad freight car industry went from 96,650 units delivered to 5,700. A 90% collapse. Things can always get worse. Myth number 7, when it rebounds to $10, I'll sell. Lynch says stocks have an uncanny ability to hover just below your mental sell price. You bought at $50, it fell to $25, and you tell yourself, when it gets back to $50, I'll sell. But it never gets there. It teases you at $48 for years, then falls to $10. Meanwhile, you're holding a stock you don't even like, just because you have a mental anchor. Myth number 8, conservative stock don't fluctuate much. Tell that to the people who own Consolidated Edison. It was supposed to be the safest utility in America. Then it fell 80%. Even safe stocks can kill you if you buy them at the wrong price or if something unexpected happens. Myth number 9. Look at all the money I've lost and I didn't buy it. This is a trap. You cannot torture yourself over every stock you didn't buy. You'll make yourself insane. Lynch says he missed hundreds of 10 baggers, but he made plenty of money on the ones he did buy. Myth number 10, the stock gone up, I might be right. Or the stock's gone up, so I must be wrong. Lynch says this is the most dangerous fallacy of all. The stock prices in the short term tells you nothing about whether your analysis was correct. If you bought Zapata because you thought oil was going up and stock rose 20% in 2 months, that doesn't prove you were right. It just means someone else was willing to pay more. And if it falls 20%, it doesn't mean you were wrong. It just means someone was willing to pay less. Now let's cover a very important topic, which is portfolio construction. Now, Lynch's portfolio is completely different from what most people do. He owns 1,400 stocks. Now, you and I aren't going to own 1,400 stocks. But the principle is important. Diversification based on knowledge, not arbitrary rules. Here's how he constructs his portfolio. 10 to 20% in slow growers for stability and dividends, 10 to 20% in stalwarts for consistency gains, 10 to 40% in fast growers for 10 baggers, 10 to 20% in cyclicals when he has an edge on the cycle, 10 to 20% in turnarounds when the risk reward is compelling. The key is he rotates between categories based on what's available. If he can't find any good fast growers, he doesn't force it. He puts more money in stalwarts or asset plays. And here's the critical insight. He doesn't hold everything equally. If he finds a Chrysler or a Ford where he has a super higher conviction, he'll pull 5% of his entire fund into that one stock. Most of his portfolio is spread across hundreds of smaller positions, but his big wins come from concentrated bets. This is exactly what Jeff Bezos talks about with Amazon. When you have a high conviction and you're right, you need to bet big, but you also need to have enough diversification that any single bet going to zero doesn't kill you. Now, when to sell? This is the hardest part of investing, and Lynch is brutally honest about his own mistakes. He sold Toys R Us way too early. He sold Warner Communications because some technical analysis told him it was extremely extended at $26 and it went to $180. Ouch, that is painful. But over time, he developed rules for when to sell. For slow growers, sell when you have made 30 to 50% or when the dividend is cut or when the company starts making dumb acquisitions. For stalwarts, sell when the PE ratio gets way above the historical average or when earnings growth slows or when the company has saturated its market. Coca-Cola at a PE of 15 is a buy. Coca-Cola at a PE of 30 is a sell. For fast growers. Now, this is tricky. You want to hold as long as the growth continues, but you have to watch for signs that the growth is slowing. New store opening declining. Same store sales going negative. The company running out of new markets to enter. Lynch uses the limited as an example. When they had 100 stores, it was screaming buy. When they had 400 stores, it was still good. But when they had 670 stores, out of 700 major malls in the country, the growth phase was over. And sure enough, the stock price stalled. For cyclicals, okay? This is what you have to do. Sell when the inventories are building up. Sell when the new competition enters the market. Sell when the commodity prices starts falling. Basically, sell when you see the first sign the cycle is turning. For turnarounds, sell when the turnaround is complete. Chrysler at $2 was a turnaround. Chrysler at $48 was a normal cyclical car company. If you're in it for the turnaround, you take your profit and move on. For asset plays, sell when the assets get recognized. When a raider shows up, when the company gets taken over, or when the gap between the asset value and the stock price closes. The one thing I wrote in my notebook, and after reading this book multiple times, here's the single most important sentence I wrote down. The person with the edge is always in a position to outguess the person without an edge. What Lynch is saying is this. Investing isn't about being smarter than everyone else. It's about I would say, having the right information the other people don't have or won't pay attention to. If you work in the auto industry, you have an edge in the auto stocks. If you work in retail, you have an edge in retail stocks. If you're a doctor, you have an edge in pharmaceutical stocks. But most people ignore their edge. The doctor invests in oil stocks. The oil executive invests in tech stocks. Everybody wants to invest in something exotic and far away because they think that's where the secret knowledge is. But Lynch is screaming at you. No. Invest in what you know. Use your edge. Warren Buffett talks about this also. He talks about investing in your area of competency. Now, Lynch tells this story about a fireman in New England in 1950s. The guy notices that local Tam Brand's plant is expanding like crazy. He doesn't have an MBA. He doesn't read the Wall Street Journal, but he figures if they're expanding the plant, they must be making money. So he and his family invest $2,000 a year for 5 years. 1972, they're millionaires. That's the entire game. Notice something, follow up, invest, and be patient. Now, here are the timeless principles. All right. Let me close with these principles from the book that will never change, no matter what the market does. Pay close attention. 1. The stock market is not a casino. It's a marketplace for owning places of businesses. If you treat it like a casino, you'll get casino results, which means you'll lose. Number 2, great companies are great investments if you buy them at a reasonable prices. Terrible companies are terrible investment at any price. Number 3, you make the most money in stocks by holding them for years, not weeks. Lynch's biggest wins were stocks he held for 3 to 5 years. Some he held for 10 years. Number 4, you don't get to be right all the time. Lynch says if 6 out of 10 of your stock picks work out, you'll do phenomenally. Well, because your winners can go up to 10, 20, 50 times, but your losers can only go to 0. 5, the best time to buy is when everyone else is terrified. In 1987, the market dropped 1,000 points. Lynch loaded up on great companies like Bargain Prices, Dreyfus, Marriott, Stop and Shop, Coca-Cola, all trading for 30 to 50% less than they're worth. If you had the guts to buy during that panic, you've doubled or tripled your money in the next year. 6, ignore the noise. Lynch says he's been through 9 recessions, 4 wars, 8 presidents, 1 impeachment, and countless crises. None of it mattered. What mattered was, did the companies he owned kept making money? If yes, the stock went up. If no, they didn't. And the last one, number 7. There's always something to worry about. In Lynch's career, people worried about the Cold War, the oil embargo, inflation, deflation, the budget deficit, the trade deficit, the rising dollar, the falling dollar, interest rates going up, interest rates going down. Does that sound familiar to you? This is exactly what's happening today. But I'm here to let you know, and I'm here to pass the message to you, is that none of it mattered. Corporate profits went up 55 times from 1945 to 1990, and the stocks went up 60%. 60 times. There's a big difference. The stocks went up 60 times. If you're waiting for the perfect time to invest, you'll be waiting forever. There's never a perfect time. There's only, do you understand the company? Number 1. 2, is it making money? Number 3, is the stock reasonably priced? And if the answer to all 3 is yes, buy it. Now, the last part. Peter Lynch, one of the most successful mutual funds in history. And this is the closing. Understand this. He beat the market by an average of 13% points a year for 13 years. That kind of sustained outperformance is almost unheard of. And you know what's crazy? He did it by following the simplest possible strategy. Buy good companies at reasonable prices. Hold them as long as the story stays intact. Don't panic and don't try to time the market. Don't listen to the noise. That's it. That's the whole algorithm. That's the whole playbook. If you want to be a successful investor and follow Peter Lynch's model, playbook, then apply everything I said in this podcast. You might have to listen to it multiple times. And here's the most important part. Most people can't do it because they can't control their emotions. They get scared when the stock goes down. They get greedy when the stock goes up. They buy things they don't understand because someone told them it's a hot tip, and they lose money. But you don't have to be most people. You can be the fireman who notices that Tambrand's plant is expanding. You can be the housewife who discovers legs at the grocery store. You can be the person who drives by the Pep Boys parking lot and sees it's always full. You already have the edge. The only question is, are you going to use it? And that's the book. That's Peter Lynch. That's One Up on Wall Street. Now go find your 10-bagger. If you enjoy this podcast, I want you to subscribe, hit the bell, and share on X because we need to spread the word. We need to spread this information. If you have comments on how I speak or how I deliver my messages, comment down below on the things that I can improve. I'm willing to listen to feedback. And somewhere in the video, I have an analysis of Tesla's earnings call. And somewhere on the screen also, if you're not interested in Tesla's earnings call, I have a breakdown of Warren Buffett's checklist for him. And this particular checklist he used to create billions of dollars. And with that being said, if you enjoyed, I want to remind you to subscribe and see you on the next episode. Peace.